So how should one approach this market now? And after a rewarding 2012, what's in store for us in 2013? Let's discuss that with Sandeep Bhatia. He represents Kotak Securities. Sandeep, good morning. Thank you for joining us. 6,000 on the ticker. Who would have imagined that a month ago?
Yeah, that's a good feeling always to see the market show buoyancy. I think the real issue is whether flows will continue. I think the flows have been a large participant to the drivers from September onwards. I would think flows will be definitely coming through in the next quarter. And through this year, I hope we exceed what we recorded last year. The earnings have bottomed out, but it's still not a very strong earnings growth story. So I think we should play for around a 20% rise in the markets this year.
But what do you think is going to take that market higher, Sandeep? I mean, what are going to be the contributors to this 20% headroom that you're talking about?
I think the first half, it will be the rate sensitives. I would think that at least a 50 basis points, if not more, kind of a rate cut by June. So I think we have already seen a part of that play out in the last quarter of last year. So it's banks, it's some of the cheap banks, public sector banks, which will show some traction. I think autos will do well. We have liked Tata Motors. We also like Mahindra Mahindra. So these are names which will do well. I think pharma still has room to go. We like Glenmark Pharma. So it would be still a stock pickers kind of a situation. If policy decisions come through and we see real change on the ground, then probably it's later part of the year we will see some of these construction names look interesting. I think in the next 2 quarters, numbers from construction and engineering will still be weak, but I would definitely look at Crompton Greaves and KAC International at these levels. There would be a holding period of 5 to 6 months before they start performing though right now, but it's good to start looking at these names.
Okay, Nifty Spot, we are only 3 points away from 6,000, only 3 points away from 6,000. If I get a month ago, I would say 10 days ago, no one would have thought that we would go anywhere close to 6,000 because globally things were looking slightly shaky. The local momentum was not all that strong. Some large cap groups were looking slightly toppy. But, in last 2 days, a lot of things have changed. A lot of global factors are now looking slightly favorable. There is abundant global liquidity. The desire to go long is clearly there. The calendar year has changed, and if I map the kind of sound bites which I'm picking up from some global institutional investors, the desire to buy Indian equities is clearly there, and I think that is very important. The sense on the street is that even after a 28% run-up what benchmark indices have reported for the year gone by, Indian markets are still attractively positioned. 5996 for Nifty. When Nifty will touch 6,000, we'll revisit that point, we'll revisit that intraday graph, but as of now, let's connect with Sandeep again. Sandeep, since you are of the view that in the year 2013, we will see a strong economic recovery, how should investors play the economic recovery theme?
As I said, in the first half, will be interest rate cut theme, which will be important. So I think the public sector banks and the auto sectors are beneficiaries here. The second half of the year could see some earnings recovery come through. If that happens, then probably the engineering and the construction stocks are names that we can look at, but that will require some more patience. So the way to play this is to stick with pharma, banks, autos in the first half, and see if the projected and anticipated earnings recovery and momentum pickup happens in the second half, and then go for the more risky names.
Sandeep, you mentioned that you're hot on Tata Motors. Now, Tata Motors for the year gone by has already appreciated by 70% plus. At a time when, globally economic growth is not stable, what makes you bullish on a business which is completely dependent on global discretionary spend?
I think first we are forgetting that it has a CV business which has gone through a very bad patch here in India. I think that if you take a 2-year view, somewhere along the line the CV business has to bottom out and start showing growth. I think this will be the year when this will happen as far as the CV business for Tata Motors is concerned. It could happen in the third quarter or it could happen in the fourth quarter, but the market will start pricing that in before that. So that's on the domestic CV business. As far as the global business, which is where your question is pointed to, I think as far as Land Rover is concerned, it's a very small player in the global luxury vehicles segment, and it had a product portfolio which was very weak. I don't think people in India can relate to the products of Land Rover, but I can tell you one thing, that those products, some of them have been in the market for more than 10 years without any significant change. I think the kind of infusion in terms of technology, materials and engines which is happening for Land Rover is changing the entire product range, making the products much better than they have ever been. So that itself, given the fact that they are so small in terms of the luxury vehicle market shares, they're primarily in SUVs, and even there the SUVs are dominated by the big German manufacturers. We will see definitely market share gains and traction coming through just because the product range has changed. So that's the key call. CV in India will bottom out this year, and the product portfolio change for Land Rover will drive sales.
Sandeep, what happens to the oil and gas space, in particular Reliance, which has done pretty okay last year? We've seen about an 18-20% appreciation. What happens from here on? And on the other hand, OMCs, even though there is talk about a fuel price hike, the stock prices don't seem to be excited at all.
Well, I put the OMCs and the Reliance in two separate buckets, though they technically supposedly fall in oil and gas. I think as far as Reliance is concerned, there are issues on capital deployment and return on capitals on some of the new ventures. We think that from here on, it's essentially a market performer. We don't expect Reliance to become a market leader in terms of performance for 2013. We saw it bottom out last year, and from then on, we thought that it would offer good returns. It's done that for the fourth quarter. I think for 2013 also, it's probably a 15% kind of a growth in stock price that I would pencil in. As far as the OMCs are concerned, I think the key issue here is the belief that the government can do something and will stick to its plan. While there are talks of diesel price hikes and so on and so forth, all this will cut subsidy burden on these OMC companies. No one believes that the government can stick to this if oil prices hike for some reason, which we currently don't anticipate that. So I think the belief and the trust in government action and ability to stick to it for a longer period of time is what is holding back OMCs. I think we'll remain quite cautious on this until we see real proof of the pudding over at least a couple of months.
Sandeep, for the year 2013, how exactly would you approach the private banking space? Would you like to stick to A-quality names like HDFC Bank, which still offer visibility? Would you like to dive into something like an ICICI Bank, which are positioned strongly if the economy recovers? Or would you bet on old generation private banks, which will benefit because of M&A activity in the sector?
No, I would think that the large liquid players such as ICICI Bank offer compelling story this year, both in terms of earnings and valuation. I would stick to businesses in the private and public bank side where there are no significant dilutions expected. That's the way to play it. I think the valuations in the private banking space and some of the leading private banks are very high, and to that extent, it's difficult to argue for a further re-rating from these levels. Earning growth for these businesses still remain in excess of 20% easily. And as I said, the market is also going to probably give you 20% returns point-to-point basis from here on. So to that extent, even HDFC Bank may not be a bad bet in terms of market and its relation to market performance. But I think ICICI Bank looks interesting, and even SBI at these levels looks interesting.
Okay, latest update on US fiscal cliff. The House has enough votes to pass the US fiscal cliff, which means the fate of US fiscal cliff has been sealed and US economy will not trip over the fiscal cliff. So the Republicans and the Democrats, essentially US lawmakers, they've managed to reach a common ground on increase in taxes and cut when it comes to spending. Sandeep, globally, do you think the fiscal cliff event could be more like a buy on rumor and sell on news event?
I think the fiscal cliff event has been averted. It has not been resolved. What we have done is, go right up to the 12th hour and try and save the world at the last second, and which is what the Americans have done. but do we have resolved the issues which led to the fiscal cliff? The kind of loggerhead political brinksmanship that the U.S. Republicans and Democrats have been doing for the last term of President Obama continues in the new term. That is not going to change. Any reading of international newspapers, magazines paints a very bleak picture of what is happening on the ground in Washington. The real test will also come in 2 months' time, when the debt ceiling for the American total U.S. federal debt ceiling will have to be raised, and talks about that will again lead to a kind of wrangling which will be actually more prolonged and protracted than what we have seen in the fiscal cliff. It essentially boils down to making very hard choices, with the government and the U.S. Congress has been avoiding till now. And that is something which will again come to the fore. So while this is news which is welcome, it does not really point to any resolution of the underlying conflicts that have emerged in the political decision-making process in the U.S.